Welcome to the Tesla Economist. Please hit the thumbs up and remember to subscribe. You can follow me on Twitter and talk to me on Patreon. As China is somewhat a different division of the rest of Tesla, I wanted to try and give it a separate valuation just based as an EV company, excluding all AI, FSD, and things like that out of it. I think if China is different from the rest of Tesla, as it is not dependent on 4680 batteries, and Tesla don't look likely to even become a battery manufacturer in China. As for valuation, I would like to place the valuation of Giga Shanghai at the end of 2023, which is when Tesla should be at a run rate of 2 million vehicles. Sorry, Tesla? I mean just Tesla China. Therefore, we will try and estimate the financials of Q4 2023 from Shanghai, and we will base our valuation on that. We will keep it as a growth company still too, as it is clearly still expanding. What's the point of doing this? Aside from it being somewhat interesting, well, I guess this could serve as a solid foundation for value, as this business system has already been proven to run successfully. The CATL LFP batteries are solid and reliable, and CATL don't seem to have much issue with ramping up too. This business is in the bag, so to speak, without trying to sound too complacent. It's been proven and tested, so let's find out what the value is of a proven, tested part of Tesla. This actually might not be that difficult to estimate. We have the number of deliveries. If it's at 2 million run rate, then we can take Q4 at 500,000 deliveries, being 2 million divided by 4. All we really need to do is try and calculate what the average selling price may be and the margins might be. The product continues to improve, even after purchases, of course. These cars offer more and more value with each update, as new features are added to the car. China can export more products to new and existing markets. Demand for EVs in general isn't even close to slowing down either. For these reasons, Tesla could raise their prices as demand becomes higher as consumers see value in these extras Tesla adds. On the other side, in this scenario, we have Tesla trying to sell 2 million vehicles annually out of China, about 4 times as many as last year. That is a lot more demand required. Perhaps Tesla will need to drop their prices a little bit to cater to that level of demand. Due to both of these circumstances, I'm simply going to keep the average selling price of each Chinese model at about what it is today. Of course, we will need to split the sales for each model, or each factory perhaps might be more appropriate. We're told to expect 1.1 million coming from the existing factories. If we continue our current proportions, we might be at around 400,000 Model 3s and 700,000 Model Ys. Then this new factory will produce another 900,000. We don't know as to what combination of 3s or Ys this factory might produce, but I think vehicles from here will have a slightly higher ASP. Of course, we'll need to divide all these production numbers by 4 to get the number for the quarter, which gives us 100,000 Model 3s, 175,000 Model Ys, and 225,000 from the new factory. This new factory will be using all the new manufacturing techniques, and as a result should be achieving a higher range in the vehicles. However, it is hard to judge as we don't know the level of 3s and Ys from this factory. Anyway, I have the Model 3 at an average selling price of 49,000, Model Y 54,000, and the new factory at 52,000. Somewhere in between the two, but on the higher side. But it would likely be higher. These are the prices without the subsidies. It ends up giving us an overall average selling price of $52,000. I will leave FSD out for now, as that is a separate business to China. It also has a very low adoption rate in China anyway. This gives us a total revenue figure of $26 billion. As for margins, well, we already assumed Tesla are getting better margins in China due to these being custom-built facilities compared to Fremont, and in addition to that, there is a general lower cost of manufacturing in China when compared to California. With all of this, I would thus expect profit margins to be 35%. I can't tell if I'm being optimistic or pessimistic with this number. It is difficult. For example, if the battery costs reduce by just $2,000, then that adds 5% onto margin, which may already be over 30% right now. We know margins are only going to improve, especially if Tesla are raising prices and not reducing them, despite costs getting lower. If anything, this profit margin may even be on the lower side, but it gives us a total gross profit of over $9 billion. Remember still, just for the quarter. Now, we're not factoring in the other sides of the business, obviously, so forget about energy and other activities. As for OPEX, well, I guess we need to decide on what proportion of OPEX might be relevant to China. I'm going to place $150 million in for R&D. I doubt it would be that much, but they have built an actual lab there for research. SG&A, I'm going to put a lot higher, all the way to $1 billion, which gives us $8 billion in operating income and a whopping 30% operating margin on a company that makes cars, when we're leaving out all the software side. leaving us $7 billion in net profit after tax. Wow. Oh wait, this is just the quarter. So if we analyze that, we have Shanghai's operations producing $28 billion in net profit. Now, we need to work out the value of Giga Shanghai. We'll be valuing it as a car company, but of course within a niche, the EV industry, which warrants a much higher PE ratio. I would say around 20 to 25 for a mature EV company, except there is no such thing. All EV companies are going to be growing for some time, unless they go under before, of course. So there'll be a lot of growth left at this stage, which should mean a higher PE ratio. Also, there are EVs and there are Teslas. Tesla will always deserve a higher PE ratio, everything else being equal. Therefore, we have a PE ratio of 20 for a mature EV company in the industry. We can then add an extra 10 onto it for being Tesla, which takes us to a PE ratio of 30. And we're not looking at the AV potential here, as that will be felt in other sides of Tesla's business. So we can't add that to the PE ratio. However, there is still a lot of growth to come. It shouldn't be too long until Tesla has once again double capacity in China and likely further reduced costs, i.e. a lot of growth remains just in China and still at this stage. I think a PE ratio between 50 and 60 is likely right for Tesla China at this stage. What about if we just say PE ratio of 55 then? Then value it based on Q4 2023 performance, i.e. $28 billion annualized, and it comes in at a $1.5 trillion valuation. Therefore, a valuation for Tesla China at the end of 2023 could be around $1.5 trillion, well over 50% of the valuation of the entire company today. Even if Tesla's entire company is $1.5 trillion by the end of 2023, then that's still a 66% return in just 2 years. That is pretty good. Except the thing is, by this stage, Tesla China won't be as much of a major part of the company then, but possibly up at around 1/3 of all deliveries might be coming from China still. And perhaps by that stage, investors' eyes have moved on to the temptation of FSD as Tesla gets closer to cracking the whole thing and dollar signs light up in our eyes, as we can only begin to imagine the riches that may unfold if Tesla cracks FSD. If we were to also add Fremont on as solely an EV company too, then I would say it might add a further $750 billion by that stage, taking us to a total valuation of $2.3 trillion in about 2 years' time. Tesla's auto business could have a valuation of about $2.3 billion. Except, of course, we have new factories operational by then, but they will be 4680 batteries. Therefore, if you wanted to remove any uncertainty you have about FSD or 4680 batteries or even energy, then you don't have to worry too much. It would appear that the existing factories we have today may alone be worth in the region of $2.5 trillion in the next couple of years. Don't you just love how profitable Tesla is? At the time of this video, that still equates to a 3 times return from today's stock price. This is just one more way to value Tesla at some other arbitrary angle, and this one checks out too. But even if you have been hit on the head lately and want to half the PE ratios we mentioned, then you're still at well over a $1 trillion valuation. You might think of these two factories as a safety net even. If all else fails, we still have this, and it looks like you still beat the S&P 500. Of course, if this was the case, that would be tragic, as we want to see an electric future. These operations, processes, and technologies have all been proven. The supply and demand has. The logistics are in place. It's all working. Of course, I think Tesla will succeed with 4680 batteries and the new factories, along with FSD and eventually robotaxis. Of course, we have energy and robots on top of that too. So yeah, that's kind of where you might see the base valuation of Tesla once they get these numbers up a bit. But we will be working on some future numbers to try and encompass as much of the overall business activities as possible to give an overall valuation. Thanks for listening. Please hit the thumbs up and subscribe. You can follow me on Twitter and talk to me on Patreon.